Hi there, this is Yuri Poletto. I am a partner of the Italian Insurtech Association and the founder of the Open and Embedded Insurance Observatory. And today I want to talk about open and embedded insurance. What is open insurance and why we are talking about open insurance today? Over the last couple of years, open and embedded insurance have become two very popular concepts. And in the midst of such a big content production, I happen to see open insurance confused with open innovation, or defined as a cool way to talk about bank assurance, or degraded to a sub-product of open banking. Open insurance is neither a lexical expedient nor a temporary trend. Indeed, it is such a relevant business phenomenon that EIOPA, the European Insurance and Occupational Pensions Authority, launched a public consultation and released a position paper on open insurance. In its position paper, EIOPA provides the most exhaustive definition of open insurance so far, defining it as accessing and sharing consumers' insurance service-related data between insurers, intermediaries, or third parties to build applications and services. In defining the scope of the Open and Embedded Insurance Observatory, we got inspired by the EIOPA definition. At the Observatory, we analyze any solution based on the access and share of insurance-related data and capabilities, usually via API, to enable data-driven insurance solutions and to make insurance a feature of a non-insurance product or service. So let's start limiting the playing field. When we talk about open insurance, we talk about shared data and shared capabilities. Actually, assessing external data and integrating insurance services into non-insurance products or services are activities that insurers have been doing for a long time. So nothing new so far. So why are we talking about open insurance today? Let's start from the first element, shared data. If the last century was the century of consumer goods, the century we live in is the century of data. We have not stopped producing consumer goods, of course, but if in the last century the dominant companies were those involved in the production or consumption of consumer goods, today the dominant companies are those that, better than others, build value from data. By early 2020, mankind had produced approximately 44 zettabytes of data, or 44,000 billions of bytes. And over 90% of those data had been produced in the last 5 years. The insurance industry, as we all know, is a data-intensive industry, but the business logic and the IT systems that support them have been conceived and designed to use an almost unchanged set of historical data. The result is that by not fully exploiting the potential of the available data, insurers have only a limited knowledge about the risks they insure or have the opportunity to insure. Furthermore, when faced with risks not supported by historical data, insurers raise the risk aversion threshold, losing the opportunity to create new markets and therefore giving up significant growth opportunities. During my career as an insurance innovation advisor, I have had several opportunities to advise my clients on the immense opportunity represented for them by new data and how to build value from them. Recently, during the interviews conducted with Accenture to make the first picture of open insurance in Italy, it emerged that only a tiny share of the over 40 organizations interviewed, for example, are leveraging on the open banking opportunity by actively using open banking data. This is an enormous opportunity to improve the knowledge of clients with qualified financial data that insurers are giving away. If open banking is a compliance-driven business phenomenon, open insurance is a market-driven business phenomenon, driven by the enormous opportunity for insurers to exploit the potential of the available data to perform their core processes more efficiently and to create new markets. Two companies that are at the forefront in enabling open insurance data solutions are Yapily and Planck. Yapily is a technology company providing an infrastructure layer that connects to thousands of banks using secure open APIs. Yapily enables companies to build fairer and better financial services for all through open banking. And particularly, it enables open insurance by using open banking data to deliver banking consumers insurance offerings at the time of need. Planck is an insurance data platform built to enable insurers to instantly and accurately underwrite any business. Planck's technology platform aggregates and mines large data sets using AI to automatically generate and deliver key insights customized to the underwriting process. The result is an underwriting process with greater insurer visibility into risk factors, leading to improved bottom and top lines of insurers' balance sheet. The second core element of open insurance are shared capabilities. The growing digitalization that is changing the DNA of all industries, from e-commerce to prop tech, from fintech to tourism to automotive, is making it easier, faster, and cheaper than ever before for non-financial companies to offer financial services to their clients. As perfectly articulated by Matthew Harris, partner of Bain Capital Ventures, in a recent post, financial capabilities are becoming a native element of the technology and business model toolbox of modern digital companies. In the mid-90s, we witnessed the beginning of the commercial use of the internet. Initially, we used the internet by developing online versions of existing businesses, and then that evolved into building new services and new markets that have in connectivity the core ingredient. The cloud followed with a similar path. Initially, software companies made their software accessible from the internet. And then they changed the rules of the game by rebuilding their applications as web native. In a completely similar way, we initially used the mobile by making websites built for desktop accessible also from mobile. And then we moved on creating new services, think to the apps, that have the core ingredient in mobile. This toolbox, consisting of the internet, cloud, and mobile, is enabling us to transform traditional financial services into digital services. Now we are witnessing a new evolutionary step, with financial services moving from a business model in their own into the fourth element of the toolbox. Financial capabilities such as payments, lending, and insurance are getting combined with connectivity, intelligence, and ubiquity, that is internet, cloud, and mobile, as the fourth element of the toolbox, with which new companies and new markets can be created. Payment services have been the first to evolve. Think that Shopify, a $36 billion software company that helps small businesses go online and build their websites. Today, Shopify sees revenues from digital payments, which is theoretically not their core business, as its main source of revenue. After payments, it was the turn of other traditional banking services like lending, and now it's time for insurance. Companies like Boost, Covergenius, Wacom offer their technology, capital, compliance, licensing layers that allow innovative companies from any industry to build, embed, and manage insurance programs. So what we should expect next? In his aforementioned blog post, Matthew Harris estimated that 40% of the payment industry will move to an embedded model, and that insurance has the potential to see up to 20% of its business moving to embedded. With the potential to draw a new landscape across insurance, technology, data aggregation, data intelligence, and analytics, and potentially every market where insurance can add value to the core offering, we believe that every founder, every investor, executive and leadership team member of insurance, B2B and B2C digital companies should look at open and embedded insurance with big interest. to figure out how to leverage on shared data and shared capabilities to build a durable competitive advantage for their organizations. Thank you very much for your attention. Hope to see you soon. Bye.